You have money sitting somewhere right now, a savings account, a checking account, maybe a brokerage account you opened 2 years ago, funded once and haven't looked at since. And every single day that money sits there idle, undecided, waiting for you to figure it out, it is losing ground. Not because of a market crash, not because of some economic disaster you couldn't predict, because you haven't made a decision. I'm Kevin O'Leary. I've built companies from nothing, sold them for hundreds of millions, and sat across the table from thousands of entrepreneurs pitching me their futures. And in all those years, across every boardroom and every negotiation, I've watched smart, capable people make one mistake more than any other. It's not picking a bad stock. It's not trusting the wrong broker. It's paralysis. It is the single most expensive financial condition a person can have. And almost nobody talks about it, honestly. Here's what I want you to understand before we go any further. If I woke up tomorrow with zero, no portfolio, no businesses, no track record, nothing but a working brain and a dollar, and I had to rebuild wealth from scratch in 2026, I would follow 5 steps in a specific order with no deviation, no shortcuts, and no exceptions. And I'm going to walk you through every single one of them today. The exact accounts, the exact platforms, the exact numbers, the exact sequence. Because here's the thing, most financial content gets completely wrong. They tell you what to invest in, they never tell you what order to do it in, and the order is everything. You can pick a slightly wrong fund and still retire wealthy. You cannot execute the steps in the wrong order without paying for it sometimes for decades. Sequence over selection. That is the principle this entire video is built on. Write it down. Tattoo it somewhere visible. I'm serious. But before I give you step 1, there's a number I need you to sit with, because most people have no idea what their indecision is actually costing them. And once you see it, I promise you the paralysis ends today. Let me tell you about a very real situation I've watched play out dozens of times. Someone has $15,000 sitting in a standard checking account. They've had it for 4 years. They keep meaning to do something with it. They've watched YouTube videos, maybe videos exactly like this one. They've read articles. They've almost opened a brokerage account 3 or 4 times, but they never pulled the trigger because they were still figuring out the perfect move. Here's what that indecision cost them. A high-yield savings account, something you can open in 10 minutes on your phone, was paying between 4 and 5% during that period. That $15,000 should have earned at minimum $2,700 in interest. Simple, risk-free, FDIC-insured interest. They earned maybe $67. The gap between what they earned and what they should have earned is roughly $2,600. Gone. Not lost in a crash. Not stolen. Evaporated through inaction. But that's the conservative version. If that money had been invested in a simple index fund, which I'll explain in detail in a few minutes, the historical average return over that 4-year stretch would have turned $15,000 into somewhere around $22,000. The paralysis tax, $8,000 on $15,000 in 4 years. And the worst part is that person still has $15,000, so it doesn't feel like a loss. That's what makes paralysis so dangerous. It's invisible. The money is still there. The damage doesn't show up on a statement, but it's absolutely definitively real. Now multiply that across a lifetime of delayed decisions, and you're not talking about $8,000. You're talking about hundreds of thousands. You're talking about retirement security, generational wealth, the difference between options and obligations. That's what's at stake when you keep waiting for perfect clarity before you act. So here is the framework we're building today. I call it the 5-account stack. 5 specific accounts, deployed in a specific order, funded according to a specific priority. This is not complicated. It does not require a finance degree. It does not require a lot of money to start. What it requires is that you stop treating this like something you'll get to eventually and start treating it like the emergency it actually is. Because financially speaking, the 5 steps are this. First, you build your emergency fund in a high-yield savings account. Second, you eliminate all high-interest debt above a specific threshold I'll give you. Third, you max out a Roth IRA every single year. Fourth, you contribute to your 401k up to exactly your employer match, not a penny more or less at this stage. And fifth, everything beyond that goes into a taxable brokerage account where you scale indefinitely. That's it. 5 steps. That's the whole architecture of early wealth building, simplified to the point where there are no more excuses. Let's start at the beginning. Step 1, the emergency fund. I know what you're thinking. You're thinking, this is the boring part. You're thinking, Kevin O'Leary is going to tell me to put money in a savings account and call it investing. And if that's what you're thinking, I need you to reset your understanding of what an emergency fund actually is, because most people have it completely backwards. An emergency fund is not cautious. An emergency fund is not the opposite of aggressive wealth building. An emergency fund is the prerequisite for aggressive wealth building. Here's why. The single biggest mistake new investors make, and I've watched this happen in real time with real money, is investing money they might need. They put their savings into the market has a rough quarter, and suddenly their car needs a transmission, or they lose their job, or a medical bill arrives, and now they have to sell, not because the investment was bad, not because their strategy was wrong, because they invested money that had another job to do, they needed it to be liquid, and they locked it up in equities instead. When you sell during a downturn, when the market is down 20, 30, 40%, you do 2 catastrophic things simultaneously. First, you lock in a loss. What was a temporary drop becomes a permanent one the moment you sell. Second, you miss the recovery. And historically, the recoveries are where the real wealth is made. The people who got rich from the 2008 crash weren't the ones who sold at the bottom. They were the ones who held, or better yet, kept buying while everyone else was panicking. You cannot hold when you desperately need the cash. The emotional pressure becomes unbearable. So the emergency fund solves a psychological problem as much as a financial one. When you have 3 to 6 months of living expenses sitting in a liquid, accessible account, untouched, not invested, just there you invest with a completely different mindset. You can watch the market drop 20% and feel nothing, because your rent is covered, your groceries are covered, you have runway, you can hold, you can even buy more. That is an enormous psychological and financial advantage. Now, here's where 2026 changes the conversation from what it was 5 years ago. High-yield savings accounts are currently paying between 4 and 4.8% annually. That is not nothing. That is not parking money in the old-fashioned sense, where a savings account earned 0.01% and you were basically hiding cash under a mattress with extra steps. At 4.5%, $10,000 earns $450 a year, risk-free, FDIC insured up to $250,000. No volatility, no waiting, no stress. For comparison, a standard bank savings account at an institution like Chase or Bank of America is currently paying somewhere between 0.01 and 0.5% on most accounts. The same $10,000 earns somewhere between $1 and $50 per year. That difference, $400 on $10,000, adds up to thousands of dollars over the years you're building this fund. The platforms I'd use today, Marcus by Goldman Sachs, Ally Bank, or SoFi, all 3 have no minimum balance requirements, no monthly fees, and rates consistently among the highest available. SoFi, in particular, has a user interface that beginners find very approachable, and they often run promotional rates for new accounts. Any of these 3 works. The specific platform matters far less than the decision to open one today. How much do you need? The classic guidance is 3 to 6 months of your essential living expenses. I want you to be specific about this number. Sit down, add up your rent or mortgage, utilities, food, transportation, insurance, and minimum debt payments. That is your monthly number. Multiply by 3 for your floor, multiply by 6 for your ceiling. If you have a highly stable job and no dependents, 3 months is fine. If you're self-employed, have kids, or work in a volatile industry, aim for 6. Pick a number. Write it on a piece of paper. That is your target. Now, here's where I want you to not use perfection as an excuse to not start. If you don't have 3 months of expenses saved yet, that is fine. That is exactly the situation this step is designed for. You don't fund the Roth IRA before you have an emergency fund. You don't open a brokerage account before you have an emergency fund. This comes first. If you only have 1 month of expenses saved, Your job right now is to get to 3. Automate a fixed amount into your HISA every single month. Treat it like a bill, not an option until you hit the target. Only then do you move to step 2. One more thing about the emergency fund before we move on. It is not an investment account. You do not put your emergency fund in the stock market because you think it'll earn more. You do not put it in cryptocurrency. You do not put it in a CD that locks it up for a year. The entire value of an emergency fund is that it is there when you need it immediately, without penalty, without having to wait for a trade to settle, without checking whether the market is up or down that week. Liquidity is the point. The 4 to 5% you're earning in HISA is a bonus. The stability is the product. I'll say this one more time and then we're moving on. Every month you delay building this fund is a month where a single unexpected expense can derail your entire investment strategy. Don't let that happen. Open the account today. But here's the thing, once you have that emergency fund locked in and funded, step 2 is where I want to push back on something you've probably heard before. Because every personal finance guru on the internet is going to tell you to start investing immediately. Get in the market. Time in the market beats timing the market. And they are not wrong, except when they are. And step 2 is the exception, because there is one situation, one very specific financial condition where investing is mathematically wrong. And if you're in that situation right now, putting money in the market before addressing it isn't ambitious. It's a leak. Stick with me, because the math on this is going to reframe how you think about debt completely. Step 2, kill the high interest debt. Let me give you a number that I want to live in your head from this moment forward. 22%. That is the average interest rate on an American credit card as of 2026. 22%. When I tell people that number, I watch their faces go blank for a second because it doesn't feel real. But let's make it real. If you have $8,000 in credit card debt at 22% APR and you're making minimum payments, you are being charged roughly $1,760 per year in interest alone. That is money that does nothing for you. It builds no equity, generates no return, creates no asset. It is a pure extraction of your wealth by someone else. And while that extraction is happening, many people are simultaneously contributing to a brokerage account or a Roth IRA, watching it grow at roughly 10% annually. Here is the math that should make this completely obvious. You're paying 22% to borrow money while your investments are returning 10%. The net result is negative 12% annually on the borrowed amount. You are going backwards. You are working, investing, doing everything right on paper, and losing money in aggregate because a 22% drain is consuming the gains of a 10% return and then some. Paying off that $8,000 in credit card debt is not a financial sacrifice. It is the single highest returning investment available to you right now. It is a guaranteed 22% return, not projected, not historical average, not subject to market conditions, guaranteed. The moment you pay that balance down, the interest charge disappears. That's a return. No stock on earth can promise you with that level of certainty. Now, I want to give you a specific decision rule so you don't have to think about this case by case. I call it the 7% threshold. If you are carrying debt with an interest rate above 7%, you pay it off before you invest a single dollar beyond your employer's 401k match. That means credit cards, personal loans, anything above 7%. Below 7%, a car loan at 4%, a student loan at 5%, a mortgage you carry it while investing. The math works in your favor at that range because historically the market beats it. Above 7%, the math works against you. It's not a philosophy, it's arithmetic. Here is what I consistently see from people who refuse to accept this logic. They say, and I've heard this in 100 different ways, but I don't want to miss out on market gains while I'm paying off debt. And I want to address that directly and without much sympathy, because it is an emotionally comfortable story that is mathematically indefensible. Let's use Maria as our example. Maria is 34 years old. She has $8,000 in credit card debt at 22%. She also has $800 a month she can direct toward either the debt or investments. She decides to invest because she doesn't want to miss the bull market. She puts $800 a month into a brokerage account. At a 10% average return, After 1 year, she has around $10,000 invested. She's also paid the minimum on her credit card, which means she's paid about $1,600 in interest alone that year. Net position, she made $1,000 in market gains, paid $1,600 in interest. She is $600 in the hole compared to someone who did nothing. Now, let's say instead she attacks the debt first. She puts $800 a month toward the $8,000 balance. In roughly 10 months, the debt is gone. Then she redirects that $800 to investing, but now she's also recovered the $1,600 she would have paid in interest. She starts investing from a cleaner balance sheet with better cash flow. By month 12, she's investing more aggressively than the person who didn't want to miss the market, and she has zero interest drag on her finances. The person who eliminated the debt first always wins over any meaningful timeline. Always. The math is not close. One important note, I said carry debt below 7% while investing. I mean, carry it while investing, not ignore it. You're still making your minimum payments, keeping your credit in good standing, and working within a budget. I'm not telling you to default on your mortgage to fund a Roth IRA. I'm telling you that a 4% car loan is not a financial emergency that should delay your investing timeline. A 22% credit card is get the high interest debt gone, then you can invest with full force, no leaks, no drain on your returns. And when you're ready to do that, when that weight is off your balance sheet and you're starting clean, step 3 is where the magic begins. Step 3 is the closest thing to a legal tax cheat that the United States government has ever allowed regular people to access. And I genuinely cannot understand why more people don't take full advantage of it. $1 million, potentially more, that the IRS never sees a penny of. That's what we're talking about. That's next. You've done the 2 things nobody wants to do. You built the cushion. You killed the drain. Most people watching financial content never actually execute those 2 steps. They skip straight to the exciting part and wonder why their portfolio feels fragile. You don't have that problem anymore. Now we go offensive. Now we talk about the 3 steps where your money stops simply surviving and starts genuinely compounding into something that changes your life. Step 3 is the Roth IRA, and I need you to understand what this account actually is before I tell you the numbers, because the numbers only land correctly when you grasp the concept. The government taxes your income. They tax your capital gains. They tax your dividends. They tax your estate. They find a way to take a percentage of almost every financial transaction you will ever make across your entire lifetime. The Roth IRA is the one door they left open. You contribute money you've already paid taxes on after-tax dollars, and from that moment forward, every dollar of growth, every dividend reinvested, every compounding gain that accumulates over decades comes out completely tax-free after age 59 and a half. You pay taxes on the seed. You never pay taxes on the harvest. The IRS gets nothing from what grows inside that account. Nothing. In 2026, you can contribute $7,000 per year if you're under 50. $7,000. That is your annual allocation into the most tax-efficient wealth-building vehicle the average person has access to. Here is what that looks like in real numbers. $7,000 per year for 30 years at a 10% average return produces $1,263,000. The taxable equivalent of that same account, same contributions, same return, subject to capital gains tax at 15% on withdrawal, produces roughly $1,010,000. The Roth version is $250,000 richer, not because of a better investment, because of the account it lived in. Open a Roth IRA at Fidelity's zero minimum, fractional shares, clean interface, excellent customer service, buy VTI. That is the Vanguard Total Stock Market ETF. It owns every publicly traded company in the United States in one ticker. You cannot get it wrong. Set up automatic contributions. Walk away. And here is the piece Fidelity won't put in the headline. Your Roth IRA contributions, not the gains. The contributions can be withdrawn at any time, for any reason, with zero penalty. That makes it a stealth emergency fund backstop on top of everything else. It is the most versatile account in personal finance, and most people either don't have one or aren't maxing it. Step 4 is short and non-negotiable. Your 401k specifically, your employer match. If your employer matches 50% of contributions, up to 6% of your salary, and you are not contributing at least 6%, you are declining free money. That is the only way to describe it. A 50% match is an immediate 50% return before the market does a single thing. No investment on earth offers you that. At this stage of the stack, you contribute to your 401k up to exactly the match threshold, not beyond it, because the Roth IRA should be maxed first, given its superior flexibility and tax treatment, but absolutely to the match. Every dollar of uncaptured employer match is a dollar you earned and chose not to collect. I have no patience for that. Check your plan documents today, find the match formula, set your contribution rate accordingly, and move on. Step 5 is where the stack becomes unlimited. Once your emergency fund is funded, your high interest debt is gone, your Roth IRA is maxed, and your 401k match is captured, every additional dollar you can invest goes into a taxable brokerage account. No contribution limits, no income limits, no restrictions on when you can access it. Open it at Fidelity or Schwab. Buy a simple 3-fund portfolio, 80% VTI for U.S. exposure, 15% VXUS for international diversification, and 5% BND in bonds if you're in your 40s or beyond, and apply one rule to every raise you receive for the rest of your career. 50% of every raise goes directly to increasing your brokerage contribution before you ever see it in your checking account. The other 50% is yours to live with. This single habit, scaling your investment rate in lockstep with your income, is how ordinary earners build extraordinary wealth over time. And for the overachievers in the room, look into the HSA, the Health Savings Account, which offers a triple tax advantage, deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses, making it quietly the most powerful account in the entire tax code for those who qualify. Here is everything I just told you, collapsed to its simplest form, because I want this to stick. Sequence over selection, emergency fund first, 3 to 6 months in a high-yield savings account at 4 to 5%, open today at Marcus Ally or SoFi. High interest debt, second, anything above 7% gets eliminated before you invest aggressively, because paying off 22% debt is a guaranteed 22% return. Roth IRA, third $7,000 per year at Fidelity. VTI, automated, forgotten, 401k to the match. Fourth, not a dollar below the threshold, not a dollar above it until the Roth is maxed. Taxable brokerage, fifth, unlimited, scalable, the engine of long-term wealth beyond tax-advantaged limits. That is the plan. Not a plan, the plan. The one I would follow if I were starting from zero tomorrow. And if you're sitting there thinking you're too late, or you don't have enough money, or you need to do a little more research before you start, I want you to go back to the number we opened with, the paralysis tax. $8,000 on $15,000 sitting idle for 4 years. That number is not a one-time cost. It compounds in reverse every single year you wait. Close this video, open Fidelity, create the account. It takes 8 minutes. And when you do it, drop stack in the comments. I want to see exactly how many of you actually move today instead of saving this video to watch again later.